So yeah, today we are going to talk about financial statement analysis, and like it is kind of the bedrock of financial investments because think about it, right? Like, how do you know the things that we were talking about until now that if certain investment is a great investment or not? What kind of investor you are? Are you a value investor? Are you an impact investor? What kind of investor? All of this depends on the financial statements of the companies that you want to invest in because you want to understand whether your investment is sound or not. And to understand that, it is very important to look at financial statements, to understand financial statements, and then analyze financial statements to get to the bottom of the crux and figure out how you are doing as an investor. You know, as I get started, I would love to go back almost 9 years. This was 2015, and you know. Because I was not a high school student like you guys, but I was like just about finishing up undergrad. Um, a 4-year degree course I completed in 3 years, so I had a year to myself. And 2015 was when I went to, I would say, a peer business school based out of Chicago, and I spent a semester over there, and the professors used to come in, and I still remember how he kind of spoke about financial statements, which uh, evoked a sense of I don't know, curiosity in me, and he told me about so he started the class by 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 an example. He said that and I quote, he said, uh, most of the people, okay, I hope most of us know about Enron and the scandal that happened with Enron, the accounting scandal, which was basically like they fudged their financial statements. So, and he started with the question that how many people do you think saw the financial statements and could not figure out what was happening? And how many of them do you think work in the biggest banks, work in the biggest funds, and are like finance honchos? So that kind of made me understand how important it is to understand financial statements and analyze them properly to figure out again, if the investment that you're making does not end up becoming an Enron. And that was by far, the most profound finance class that one day that kind of changed, yeah, who I was. But yeah, let's get started. And I hope that what we go through today also ignites the same kind of curiosity in you, and you delve into more financial statements, you try to analyze them, and go deeper into the financial world. So there are three main key financial statements that we have, which kind of talks to each other, which kind of tells you about the company and tells different things about the company, right? And these three are basically the balance sheet, the income statement, and the cash flow statement. No, the balance sheet is basically you list the assets of the company and the liabilities of the company, and it practically runs on the equation that assets must be equal to the liabilities plus the shareholders' equity. So in a way, it tells you that if there is a mismatch somewhere between the assets and the liabilities, then you need to take a deeper look. If there are mismatches between, if the equation does not add up, then you need to take a deeper look. So balance sheet kind of tells you more or less the health of the company, and we'll go on to see how. Now, looking at the income statement, right? The income statement kind of talks to you about the revenues of the company. Okay, what's the top line look like? What is the okay, the top line is something like what is the total gross revenue of the company looks like, then what are the expenses of the company that looks like, and ultimately what's the net income of the company, because although gross revenue is a very, very important aspect of the income statement, but the net income is what actually this corporation is earning, right? And therefore, it becomes a really, really important tool when you're thinking about the company, when you're analyzing the company. That the income statement kind of provides you insights into if the company is profitable or not, how is the operational performance of the company. It kind of tells you what's the gross revenue of the company, and then if the expenses are more than the revenue or the expenses are less than the revenue, in which case it gives you a profit, or in the other case it gives you a net loss. And it kind of tells you which stage the company is in, right? Like, say, for example, if you're thinking about a startup, of course, the revenues would be less than the amount of expenses, right? Because they're ramping up, they are spending more to build their product, they are spending more to um, take their product to the masses. And therefore, of course, the amount of revenue right now would be less than say the expenses. Whereas you go to a very mature company, say a company like say Amazon, they would have a huge revenue, but their expenses would be lower because of the economies of scale, right? Because they are kind of working on a broad spectrum, right? And that will kind of tell you that how much their net profit is. So it also tells you what stage the company is in, and kind of reflects that through the income statement. And lastly, I think it's the cash flow statement, which kind of reports what are the cash inflows, what are the cash outflows, and the cash flow statement is very key to evaluate, the company's ability to kind of generate and manage cash. And essentially, the cash flow statement kind of tells you about the health of the company, right? Because say you want to understand like how much cash is flowing through the company, right? Because it kind of gives you an understanding of, say, what are the products of the company that are selling the best, what are the products of the company that is not doing so well, right? Similarly, you can also look at what are the main expenses of the company, where is the money flowing out, right? And think about, okay, is this a proper project where I want the money to flow out or not? So it kind of tells you a lot about, it's like dissecting a company, right? Um, it tells you things like, okay, where there is a leak in the pipeline, right? Like, for example, suddenly you see that cash is disappearing, right? And then you figure out, okay, the company is spending a lot of cash on a certain project. And then you think of, or try to understand the viability of that project, to take a call if the cash flow for that project is worth it or not. So these are the three statements, and these are very, very, very important, I would say, the foundation of the finance world. Every company builds all these three statements, and whether you're an investment banker, any kind of banker, whether you are a fund manager, whether you're an investor, you fall back on these three key financial statements to understand what's going on within the company, and how healthy the company is, and if this is the company that you should invest in or not. Uh, yeah. So let's go a little bit deeper into balance sheet, like we spoke about, right? The balance sheet is all about the equation that assets is equal to liabilities plus the shareholders' equity. Now let's talk about assets. Now, different companies would have different kinds of assets, right? Like, for example, uh, uh, again, for example, say Amazon, if they own warehouses are the assets that they have, right? Uh, say, for example, if it's a very known name, that name is itself an asset, right? So there are different kinds of assets that the company holds, which have a lot of economic value. Now, assets are further divided into current assets and immovable assets, or something that you cannot liquidate very easily, right? So current assets are assets which you can liquidate very easily, like something like cash. So you have that in your hand, so you can spend it just even today, right? Whereas something like, say, a warehouse, or something like, say, for example, a factory. Now these are immovable assets. These are not current assets, right? These are long-term assets. So to liquidate them, you take much more time, and therefore uh, assets are divided into like current and long-term. Now, let's go to liabilities. Now, liabilities are basically obligations or debts that the company has to pay, right? Like, say, for example, um, say the company has taken a loan from a bank, and they need to pay it back. So that goes into the liabilities, right? Say, for example, say you are a consumer, right? And you want to buy a Nike shoe that's gonna launch, uh, say 6 months from now, right? And what you did is that you booked those shoes in advance by paying something to Nike. Now, for Nike, the payment that you have given them, say $100, becomes a liability until and unless they have shipped those shoes to you and you own those shoes. So these are liabilities. Now, liabilities can also be divided into two parts. One would be current liabilities, the other would be non-current liabilities. Now, current liabilities would basically be mostly short-term loans, whereas non-current liabilities would be like long-term debt over, say, 20, 30 years, and sometimes more. Um, now, one of the things that when looking at a balance sheet, you look for is that, say, how much are the current assets and how much are the current liabilities? Because think about it from an obligation standpoint, right? You should have current assets more than current liabilities, because you need to meet those liabilities, right? And therefore, these are the things that you'd look for in a balance sheet. The third would be shareholders' equity, which is also kind of sometimes known as owner's equity, or this is basically your value of the common stock that you hold, right? So uh, there's a debt value of the company, then there's an equity value of the company. So yeah, the shareholders' equity holds all the equity value of the company. So we can go to a little bit more deeper. What does assets have? So assets would be cash, cash equivalents, accounts receivable, the inventory that you hold, the property that you hold, say factories, plants, equipment, and goodwill. Now, goodwill is a very interesting concept, because it's something that you cannot measure, right? But it's an asset. Say something like, say, for example, for folks from the United States, right? We somehow trust, say, the banks, right? Like, say, for example, I bank at Bank of America, and I trust them. I sometimes I always feel that this is a huge bank which I can trust on, which I can keep my money in, and use its product. Uh, that's goodwill, and that has a value, right? Because I don't feel like that with all the banks, right? But I feel that with, say, Bank of America. And that is because I will give, say, my business to Bank of America, right? So that is an asset. Now, that's very hard to formulate in numbers, but somehow we kind of build that. We will not go into it, but yes, we quantify the goodwill asset that the company has, as it is evident, right? Like a higher asset value indicates like a strong finance position of the company, and a lower liability also means that financially the company is doing really well, which means that you don't have to borrow money to run the company, right? So let's go to liabilities. Now, for liabilities, we will have accounts payable, accrued expenses, short-term loans, long-term debt. If you have higher liabilities, it means that it's you have taken up a lot of money to say either run the company or kind of build something new. And only when you have very high liability and not that high of an asset, it might signal to you that there is a risk of financial distress in the company and you'd want to take a further look into it, right? But for just every day, if you're going through a balance sheet, just look at the current assets and look at the current liabilities. And if the current assets are more than the current liabilities, which means that in the short term, this company is not going to go bankrupt. So it's kind of protected. And lastly, shareholders' equity. I think common stock, retained earnings, these are all part of the shareholders' equity. When you grow the shareholders' equity, it indicates that a company has the ability to reinvest profits and support the future growth. And this is what every investor wants, right? Like, because as the company grows, the valuation of the company will also grow. Valuation, which is we spoke about last class, that valuation, which means the worth of the company will also grow, which will support future growth, right? And as an investor, that is all that you want, right? That is, it makes a lot of sense to you. So let's look at income statements. Income statements would be, like we talked about, gross revenue. Then you subtract all the expenses that you have for the company, which takes you to the net income. Now, the gross revenue, which is on the top, is basically what is called the top line, and the net income is called the bottom line. This is because, as you can see from this diagram, that the net sales is the first line of the income statement, which gives you the gross revenue, and the net income is the last line, which is in the bottom, right? That's why gross revenue is called the top line, whereas the net income is called the bottom line of the company. And so revenue is nothing but the income that is generated from the sale of goods and services or products which the company builds. Expenses are the costs that this company incurs in generating this revenue, right? Like, say, for example, Amazon. Say Amazon does not own what it sells, right? But so therefore, say it makes some revenue, but it also have a cost of the goods sold, right? Which it has to pass on to the retailers, right? Like, say, for example, pass on to say if they're selling Nike shoes, they have to pass on that cost to Nike, right? And then they have a net income. The net income is the bottom line of the income statement, which is basically nothing but revenue minus expenses. It's the income statement is the easiest one to build if you're ever building a financial statement. You just have to understand how much the revenue is coming in, what's the expenses of the company, and then come to the net income or net loss. So income statement, again, the three things: revenue would come from the sales revenue, the service revenue. There can be some interest income, some say royalty income, and a higher revenue generally indicates strong demand for the company's products, which means that they are being able to sell a lot of the products that they are building, which is a good sign, which means that the company is in high demand. For expenses, there are cost of goods sold, salaries and wages, rent, depreciation, amortization. Now, analyzing expense is fascinating because, like I told you guys, right? Expense is where you find out where the company is spending and why it is spending. So once you figure out where the company is spending most of its money, then you ask questions like, why is it spending so much there? Which kind of also tells you if, like, say, for example, the company is efficient or not, or is there any way the company can get more efficient in its processes, and what are the cost management strategies that the company could take in. And lastly, the net income, as we all understand, right? If it's positive, it represents a profit. If it's negative, it represents a net loss. This net income will also tell you a lot about the maturity of the company, because early stage companies would have loss on their books, whereas late stage companies or mature companies would see a lot of more profitability and financial success. And lastly, I think we will talk about the cash flow statement. The cash flow statement is basically kind of divided into three activities, like what are the cash flows from operating activities, what are the cash flow from investing activities, and what are the cash flow from financing activities. Now, as you can understand from the names itself, now cash flows from operating activities are basically the flow of cash from the operations of the company, right? Like more like uh, the services and products they are selling. What's the cash that is flowing in from that sale of products and services? Cash flow from investing activities are what is the cash flow that's happening because of the investments that the company has done, right? Like say, for example, uh, say the company bought a new machine and it kind of fastens the process of producing the goods, right? So this is the cash flow from investing activities. So which is like, what's the money that went out to buy those, say, machines, right? What's the money that's going to come in because we are using those machines? And lastly, it's about financing activities. So cash flows related to transactions involving the company's capital structure, um, like say you repurchase shares or you repay loans or you take new loans, right? You get new loans or you pay dividends. So these are cash flows from financing activities. So basically it can be cash flowing out of the company or it can be cash flowing into the company. Again, as we talked about it, operating activities could be cash receipts from customers, cash payments to suppliers and employees, interests and taxes paid. A positive cash flow from operations indicates that the company is doing well, that the company is being able to sell its products and therefore generate a lot of money from its core business, right? What it was meant to do, the company was meant to do. Then we have the cash flow from investing activities, which can be again like discussed purchase of property, plant, equipment, or proceeds from the sale of assets or acquisitions that we do. Say a company wants to acquire another company, that the cash flow that went out to acquire that company would fall under the investing activities. And then there's of course financing activities, which is like proceeds from issuing stock or debt, repayment of loans, payment of dividends. These will all fall under financing activities. Now, when you have all of these three statements, right, it's these kind of tell you about the health of the company. These kind of tell you about uh, how the company is doing. But what are the few or two main kind of ratios that you need to know or need to calculate to understand these financial metrics, right? There are two. One is the liquidity ratio, and the other is the profitability ratio. Now, the liquidity ratios are two. There are two that you need to know. Of course, there are a lot more, but I include only two because these two are very important. Like we talked about, the current ratio, which is the current assets divided by the current liabilities. It has to be positive. The more in value the current ratio is, the better the company is. So one of the things when you go ahead and go to your global youth meetup or the stock track competition and you look at companies where you want to invest, try to analyze their current ratio. The better the current ratio, the better the company is at this point of time. We don't know what happens tomorrow, but at this point of time, it is doing better than all the other companies whose current ratio is less than these companies. Then we have the quick ratio. Now, the quick ratio kind of tells you that what's the quick ratio kind of tells you how far away it is from, say, an imminent kind of bankruptcy. So a higher quick ratio means that the company is healthy and you can go in and invest. A very low quick ratio would tell you that the company is risky. Maybe you'd get better returns on your investment, but it would be a risky investment because it might go into bankruptcy at any point of time. And then we would look at profitability ratios, which assess the company's ability to generate profits. At the end of the day, understand something. Share prices or stock prices are very dependent on how the companies are performing. It's very dependent on the ability of companies to generate profits, right? And therefore, it's very important for you to understand these ratios to figure out which company you want to invest in, right? Um, we have a gross profit margin, which is basically the revenue minus cost of goods sold, which gives you the gross profit, and divided by the revenue. That would give you the gross profit margin. A healthy gross profit margin tells you that on a unit basis, the company is doing well. The net profit margin is the net income by revenue. The return on assets. Return on assets is something that you can still like not be very worried about. And then return on equity is net income by the shareholders' equity. If you are a long-term investor who is dependent on, say, dividend income, who's dependent on how what the equity that you hold is returning to you, then return on equity is one of the very important ratios that you should definitely look at. Then we have leverage ratios and efficiency ratios, right? Now, leverage ratios would actually tell you about is the company over leveraged or is the company under leveraged, right? Like say, for example, uh, can the company meet its long-term financial obligations, and can the company meet its short-term obligations, right? So a debt to equity ratio, which is total liabilities by shareholders' equity, tells you about how much debt is there in the company and how much equity is there at the company, right? You don't want to go into a company which is more on debt and less on equity, right? Then the interest coverage ratio, operating income divided by interest expense, right? Say, for example, the cash that is flowing in from operations, right? Your operating income should always be more than the interest expense. Because if your interest expenses are more than your operating income, uh, the company might be over leveraged and again, might not be able to meet its debt obligations. So you have to be careful at that point of time. Uh, Efficiency ratios measure how effectively a company manages its assets and operations. So like something like an inventory turnover, which is cost of goods sold by the average inventory, tells you about how fast is the company churning through its products, right? Like say, for example, it produced say Apple produced 100 iPhones. How fast is it selling those 100 iPhones and producing the next batch of 100 iPhones? The faster it is, the better, which means because it tells you that the company's products is in huge demand in the market, which means that more revenue, which means more worth of the company, more higher valuation for the company, which ultimately means that the stock that you own is going to grow in value. And also receivables turnover, which is revenue divided by average accounts receivable, which is like how much is the receivables and how efficiently is the company being able to turn it over. So I think evaluating a company's financial health is basically integrating information from all of these financial statements. So to evaluate a company's financial health, it is very important to understand the interconnectedness of the balance sheet, the income statement, and the cash flow statements. Together, it kind of tells you about their profitability, about the liquidity, about the leverage that it has, and the operational efficiency. So, of course, look at all of these different financial statements separately, but when you're analyzing, look at them together, because together is when you will actually hit Eureka and you'll figure out that on a totality basis how the company is doing, and on a totality basis if the company is kind of making sense for you or not. Again, all three of them together, you can access liquidity and solvency with the help of the liquidity ratios that we saw and the solvency ratios that we saw. These also tells you about the health of the company, right? It tells you that you don't want to invest in a company. Of course, again, like we go back to the other workshops, and it depends on what kind of investor you are. If you are an investor who can take an enormous amount of risk, maybe you can go with a lower liquidity and solvency, right? Because you are like, I want a higher return, and I can do with some more risk, because there is a chance that the company can go under, which means that the company can go bankrupt. But if you are someone who cannot take a lot of risk, then The liquidity and solvency ratios will tell you that the company's health is good or bad. And if it's good, you go ahead with it. If it's bad, you leave that company aside. And similarly, for profitability and operational efficiency, you look at, okay, is this company the most efficient or not? So like, for example, again, for people who are doing the stock track competition, go sector by sector, look at one sector and kind of look at the profitability and operational efficiency of all the companies, and then kind of choose the company which has the highest amount of profitability and operational efficiency, because no doubt in that sector, that company is going to win the market.